Hi, I'm Paul J. Welcome to the theAnalysis-news podcast. As the economic crisis deepens, many states are having a resurgence of the COVID pandemic and will be soon probably closing down again. Those are mostly states that opened too early. But it does not look like a quick fix to the recession, nor is there going to be a quick opening in a broad way of the economy or a quick lessening of the millions of people who are unemployed. The Fed has shown, however, that when it needed to, it could come up with a lot of money. It's committed to about $4 trillion of stimulus in one way or the other. I say one way or the other because there's a chunk of this money is being spent to defend the assets of wealthy people to prop up the stock market. Some of it is being spent to help subsidize going towards the federal government being capable of adding to the unemployment insurance and other kinds of direct payments to workers and small business loans and such. But a large part of the money is going to prop up the value of assets, and rich people have more assets than non-rich people. At any rate, if there's going to be a change, and if there's a Biden presidency and there's actually any political will to have real reform, that reform is going to have to maybe even start with the Fed and what its role is, because the Fed has the ability to finance programs of all types. And the question is this Fed going to be funding programs that actually benefit the broad population or continues to essentially prop up assets of the wealthy? So now joining us to discuss this is Gerald Epstein. He's a professor of economics and co-director of Political Economy Research Institute, Perry, at the University of Massachusetts Amherst. His recent book is Political Economy of Central Banking, Contested Control, and the Power of Finance. Thanks for joining us, Jerry.
Thanks for having me, Paul.
So I would like to have a bit of a blue sky, as they call it, discussion, meaning what could one do with the Fed if there was a real progressive government with a progressive mass movement to support it. And of course, it's going to run into, as in the title of your book, the real power of finance, which is considerable. But first of all, let's just start with, for people that don't really have a handle on how and why we have a Fed, why do we have a central bank that is so much controlled by private bankers?
Well, there are central banks in most countries around the world, and the history of central banks is that most of them started off as private banks. The Bank of England, the Federal Reserve, other banks. But most of these private banks, central banks, evolved and were taken over by the government. And at that point, the private banks lost formal control over the central banks. The Federal Reserve, however, is different in that the private banks have continued to have a formal role as being members of the boards of directors of the regional Federal Reserve banks, of which there are 12. And the Federal Reserve has a lot of influence by bankers informally, where bankers play a very important role in helping to frame what the Federal Reserve does. There's a revolving door between Federal Reserve officials and Wall Street. This is true to some extent of most central banks, but it's extreme in the case of the United States, and should say the Bank of England as well. Now, it's time to get the banks out of the Federal Reserve and make the Federal Reserve a clearly non-bank public institution.
Yeah, because there's a lot of talk, especially on the theAnalysis-news, but other places, about the need for public banking. Well, it's kind of crazy. The most powerful bank in the country really is the Fed, and it really should be a public bank with a public interest mission, not a stock market interest mission. But as long as the Fed is more or less controlled by people who are all connected to asset management and stock markets, how is it going to play any other role but to make that its priority? So what would it take to make the Fed a real public central bank?
Well, before we go there, let me just say I think these two crises we've had back to back, the great financial crisis of 2007, 2009, and now the fallout from the corona crisis, has really made the point very clear what you just said. Namely, in both cases, the Federal Reserve was confronted with a real crisis for the whole economy, for workers, for homeowners, for states and locales, and so forth. But in both cases, and it's become increasingly clear this case, that the Fed has primarily bailed out the wealthy by propping up asset prices, the stock market, lending money, corporations buying corporate bonds. So they created a lot of facilities to buy assets and make loans, and most of these benefited the wealthy and the banks and the corporations. For the first time, though, they were also created facilities from pressure from the Congress to help out workers and state and local finances, but and medium-sized businesses and small businesses. But these facilities have been so poorly constructed that the Federal Reserve has given very little in the way of loans to state and locales and others. So most of the support that the Fed has given to Wall Street. And that's just because that's their natural operating procedure. It's been that way for decades. And it's because of this nexus that we just talked about between Wall Street and the Fed. And that has to change.
And we've done some stories about this, but I think it's important to make the point again. They're actually propping up the stock market. I mean, it's like a ridiculous situation. Millions of people unemployed. The real economy was at a halt, and it's still to a large extent at a halt. You know, by all normal reckoning, the stock market should be tanking, except it's back to historic highs. It's insane. And that's because of what the Fed's doing.
That's right, because the Fed is buying financial assets, pledging to keep interest rates low indefinitely. And that's a natural boon to people who own financial assets, where instead of that, it should be lending directly to those that need it, small businesses, states and locales, workers and nonprofits. And even though the Federal Reserve set up some facilities that's made some initial steps towards doing that, they've created them in such a way that it's so costly for people to borrow from it that it's not being used.
Yeah. Let's talk a bit about this. They've committed like $4 trillion of various kinds of stimulus money because of the pandemic. But what is it? Something less than $1 trillion has actually gone out the door. What's going on here?
Well, let me give you an example of something that I've been working on quite closely. As you know, states and locales are in terrible trouble. The ideal way to help that would be for the government to give grants to states and locales to help fund education, their healthcare systems, etc. But the government isn't doing that. The Congress has passed first the CARES Act and then the HEROES Act, but the Senate hasn't picked up the HEROES Act. So the Federal Reserve created this facility to lend to municipalities and state governments. It's called the MLF, the Municipal Liquidity Facility. It can lend up to $500 billion to states and locales to fund their activities. But they set the interest rate so high and the term so short, that is only 3 years, that only one state, Illinois, has borrowed from it. So they have $500 billion capacity to lend, and only about $1 billion or two has gone out the door because the Fed is just uncomfortable with lending to the people. It's uncomfortable with lending to the real economy. It's mostly comfortable with lending to Wall Street.
Okay, so let's start to imagine that there's this movement in the streets is able to get at least back in the streets, and if not, online in a big way. Let's imagine, and this is not a big stretch, Biden does get elected. And if the election was today, I don't think there's any doubt he would be. But let's see what happens by November. If not, assuming Biden's still with us and assuming Trump's still with us, and who knows what shenanigans Trump has in mind. But let's assume things take their course. What would a progressive's demand if by any, Biden created these committees with Sanders to come up with different kinds of proposals in different areas. Interesting enough, not a single joint team on foreign policy, but that's a different question. But when you get to the question of finance, the financial sector, the power of finance, and specifically the Fed, what would your recommendations be? And let's just assume the best.
So there are at least two broad aspects to this. One is financial regulation, and one is transforming the financial system, including the Fed. Now, interestingly, out of these two crises that we've had, there have been some kernels of genuine reform that have come out of both of those that have been stifled or ignored, but could be built upon. So, for example, after the great financial crisis, the Dodd-Frank Act, there was a lot of discussion in the process of that actually would have been very important to do. One is breaking up the big banks, putting on asset caps or something like that, getting rid of derivatives or regulating derivatives and other kinds of risky assets, regulating the shadow banking system, including the asset managers, which I know you've been talking about. All of these things were proposed in the Dodd-Frank discussion. A couple of them were implemented, or at least put in the bill, but they were never implemented. And now it's been totally ignored. But there's a lot of discussion that came out of Dodd-Frank that could be implemented and would make a big help, including primarily breaking up the big banks and getting the shadow banking under control.
But the problem with breaking up the big banks is that these smaller banks that are left, aren't they still more or less in the control of the same pools of capital? And as we saw from telecom, when they were broken up, over time they kind of all get back together again. Isn't there a need for real public banking on a large scale to counter that power? I certainly wouldn't argue against breaking up the big banks, but I don't see how that on its own deals with it.
Yeah, no, I agree with you. So in order to sustain that and to make sure that the financial sector operates in the interests of the people, we do need a significant public banking sector. And in order to get a public banking sector, we need some centralized infrastructure to support and subsidize and help develop this public banking sector. And that's where that links to our discussion of the Federal Reserve. What the Federal Reserve has been doing is subsidizing and supporting for decades the megabanks and the private banks. But what we need is an institution. It could be the Federal Reserve. It could be another institution whose job it is to provide the backstop, the loan guarantees, the subsidies, lines of credit, etc., to support the development of a whole variety of public financial institutions. Financial institutions at the local level, at the regional level, financial institutions nationally, for example, a green bank or a set of green banks to help finance the Green New Deal. So these banks cannot sprout up on their own. They need an infrastructure created by the federal government. And if the Federal Reserve isn't the right institution to do that, then we need to create a banker's bank, a banker's financial institution to underwrite all of these institutions. So I completely agree with you. We have to break up the large banks, and we have to build a network of a variety of public banks that are supported by the federal government.
And what do you do with these big asset managers like BlackRock and Vanguard? They claim they're passive investors, but I think the evidence is that they're more than passive. They even on their own website, BlackRock says they engage informally with the management of companies. We know they control the votes, essentially control the voting of about 96% of the S&P 500, and they've become the real behemoths of Wall Street. I think they're up around 15, somewhere between 14 and 17 trillion dollars now. I'm not sure after the COVID closing where they are exactly, but they have more wealth than the GDP of China. How does the Fed relate to the power of them? They claim, as I say, that they don't get involved, but they do, and the concentration of ownership is beyond most people's imagining.
Yeah, so there are a couple of things here. One is there never were adequate regulations put in for the non-bank financial institutions, like the asset managers, the private equity firms, the hedge funds, et cetera. That was completely left out of the Dodd-Frank. There were discussions of doing it. So for one thing, you need a regulatory umbrella for all these institutions, including the asset managers. But then there needs to be a specific antitrust orientation towards the way the government deals with these behemoths that help to concentrate power. And so there has to be a regulatory, but then an antitrust element to that that's implemented. And I don't think the Fed is necessarily the right institution to do both of those, but we do need both of those to happen. In terms of the Federal Reserve itself, again, there's lessons that we can draw from the most recent crisis, and the ways in which the Federal Reserve has been pushed by the Congress, by progressives in the Congress, to do more to help out Main Street, to help out state and local governments, to stop its singular focus on Wall Street and start helping out others. There's two things about this. One is that it shows that this whole fetish of having the Federal Reserve be quote unquote independent is no longer politically independent, is no longer feasible if it ever was. In fact, the Federal Reserve was never independent of Wall Street. It was just independent of the democratic process. But now, with the two crises, it's clear that the Federal Reserve has to be part of the overall government apparatus that revives the economy and that allocates resources to where they need to go. And this includes, as I talked about earlier, the Green New Deal, public banking, dealing with the huge racial disparities that we have in our country. And what this means is that the Federal Reserve its policies have to be integrated clearly into the government. Now, one way to do that without risking a total centralization of the Fed, which I think is dangerous, is to build on the regional Federal Reserve structure that was created in 1913. That is, we have these 12 regional reserve banks, and these regional reserve banks can play an important role in managing credit policies in their districts, in having more democratic membership of the regional reserve banks. It can become a very decentralized system where that's better, where it's more democratic. But of course, there still will have to be the centralized component of it in the Board of Governors in Washington, where it's integrated into the goals of the administration.
So, in your model, how does the Board of Governors get selected? I mean, should it be elected?
I don't think it should be elected. But what we need to do is make sure that the Board of Governors, that there's a real selection process by the President and by the Congress that has a slate of candidates that is broadly representative of people, of the unions, of racial minorities, and so forth. That has to be written explicitly into an amendment to the bylaws of the Federal Reserve. That it has to be more representative of society as a whole, just as there are designations like that in the designation of the boards of the regional reserve banks. That has to be true of the Board of Governors as well. This is very important in terms of the integration of the Federal Reserve into the overall fiscal policy, because following the crisis, if we ever get out of this, there's going to be a very large budget deficit. The hawks among both the Democrats and the Republicans are going to call for raising taxes, cutting government expenditure, and so forth. It has to be very clear that the central bank can continue to finance significant deficits up to a significant degree. I don't think it's unlimited the way some do, but certainly up to a significant degree, so that we can really get out of this corona crisis without falling back into this austerity the way that happened after the great financial crisis.
What do you think the limits are?
I think the problem is we don't know what they are. We know some of the characteristics of things that would generate limits. We know that if the United States government keeps flouting international norms, cutting off international diplomacy, cutting off our trade and financial relations with the rest of the world, that the international role of the dollar, which is really the linchpin of the United States being able to borrow extensively in the open markets, if all that continues to erode the way it has under President Trump, then that makes it much more likely that some other currency, like the Chinese yuan, the euro, some other currency, will really come up and seriously rival the dollar. And in a seriously multi-currency kind of system, I don't think these are going to replace the dollar, but in a serious multi-currency system, then the ability to borrow internationally indefinitely is called into question. And once it's called into question, then that generates fears and risks and so forth, so that it's much easier for investors to dump at the dollar if they think the deficit's getting too large, et cetera. It just becomes much more difficult to manage the economy with a massive deficit. So I think in some ways that is the major constraint on the ability of the United States to continue running this game here.
So it's essentially a confidence game. As long as people think the American dollar is credible, then it is. But if they start doubting it, then it isn't. Is that?
I think that's what it amounts to pretty much.
I saw an interesting study by the Brookings Institute from a couple of years ago, and they calculated the total amount of assets in private hands, and meaning wealth minus liabilities. So I can't remember the exact number of the total amount of wealth, but then they divided it by the population of the United States. And there was enough wealth to pay, if they divided up all the actual assets, to every individual over $300,000 per person, meaning a family of four would get, over $1 million. So there's a lot of actual wealth backing up this investment, the stimulus. I would assume if there's any objective measure of how much debt there can be, it has something to do with how much what is the aggregate of wealth in the country? Because in theory, at least, the state could, if it had to, tax some of this wealth back. Does that enter into how people envision why this and how far this spending can go?
Sure, and you're right that a wealth levy, a wealth tax, if it came to that, as has been, as took place in some countries after the Second World War, as has been recommended for Italy, its deficits, its debts running so high, et cetera. That is certainly one possible way to deal with this problem, were it to come to a ahead. So there's no question that the United States has a lot of capacity to run deficits. Part of it is what I was talking about. Part of it is the wealth. And and part of it is the fact that a lot of the borrowing that the United States engages in is from U.S. citizens themselves. It's not from foreigners at all. So,
yeah, the majority is that, isn't it? I did an interview with Mark Blythe the other day, and he was saying that too. That when you see this debt, you have to realize that for the flip side of that is that it's savings for mostly, Americans, mostly wealthy Americans, but still, it's not like it's left the shores or something.
No, that's right. But of course, yes. So that gives a lot of flexibility as well. But it's at the margin that it's the foreign debt. And we economists are fond of talking about, well, what happens at the margin if the Chinese start dumping American debt, then is that going to really change the exchange rate and the interest rates in such a way that it would cause a problem? I'm not expecting that scenario. I'm just saying it's comforting that a lot of it is owned by Americans, but a lot of it also is owned by foreigners. Anyway, the point is, I think right now, most economists agree that the United States, given our wealth, given the role of the dollar, et cetera, has a huge capacity to borrow. And it's really important that the politicians and the Federal Reserve are on board if a Biden administration were to come into power, not to impose an austerity kind of policy. It would be a terrible mistake. That's what happened to Obama and many other center left or center governments around the world, and it would just be a disaster.
Let's go to something concrete that the Fed could do now without a major reform of its structure. You have a proposal for what you're calling human capital bonds. How does that work?
So this relates to what I was talking about earlier. States and locales are in terrible financial situation, and this includes funding of schools. Trump keeps talking about open the schools, but a lot of state governments don't have the money to pay teachers. And the reason why states are in such terrible financial shape is because tax revenues have fallen through the floor. And of course, there's extra expenses associated with virtually all these state government activities. Now, the first choice would be, as I said, to have the federal government give large grants. Some people have estimated that we need $500 billion, others $1 trillion to states and locales to fund public services, including education. But short of that, the Federal Reserve has the capacity and has already facilities set up that could lend up to $500 billion to fund activities like education. The problem is that most states have balanced budget laws. That is, they're not allowed, they have to have a balanced budget when it comes to current expenditures, like for salaries and so forth. They're allowed to have a capital budget, however, to build buildings and roads and bridges, et cetera, things that are of longer gestation. So even if the Federal Reserve did open the spigot and was willing to lend to states, could the states really borrow to pay for teacher salaries, salaries of janitors in schools, et cetera, et cetera? And most states would be very constrained in their ability to do that because their current expenditures. So my proposal is that states should be allowed to issue human capital bonds for education, for current educational expenditures, understanding that investing in education of our young people is one of the most important and most productive long-term investments that there is. And it's kind of a misnomer to think of this as current expenditure, for teacher salaries, et cetera. This is really a type of infrastructure investment. And this would help states, I think, be able to borrow longer term to fund current expenses in education, especially during the crisis, without having their credit ratings reduced or impaired. So I've been working with some Massachusetts legislators and some others to see if there's any interest in this idea and we can push it forward.
But they're going to have to do something like this because the states and the cities are going into a catastrophic financial situation. There's not going to be money to pay firemen and policemen and teachers and so on without some kind of massive federal help.
That's right. And maybe Mitch McConnell will realize that, and the Congress will do what it should do, which is actually give this money to the states. But there's a second track to move along as a backup for that kind of support, and especially certainly if it doesn't come through.
Well, maybe this becomes the what some of the far right ideologues, which includes some of the billionaires behind Trump, but others have wanted, which is really the destruction of government. They're going to wind up getting it at the state and local level at any rate.
Well, they probably have mixed views. They want to destroy, as you know, for many years, they've wanted to destroy the unions and all public and social services. They wanted to privatize education as much as possible. But they've always wanted to leave the people they perceive to be harder to educate, or poorer people, or minorities, to be taken over by the state. And there has to be, at least even from their perspective, some minimal funds to educate the rest of the people. It's a horrible vision, but that's probably the vision that they have.
All right. Thanks very much for joining us, Jerry.
Okay. Thank you, Paul.
And thank you for joining us on the Analysis.news podcast.